Chapter 14 Internal Control and Audit. In this chapter, we will go through all key components of internal control and audit and why they are important in corporate governance. So first, introduction of the chapter. Internal control and audit are highly connected. They all contribute to best practices in an organization. So best practices in an organization to help its management to achieve the objectives. So we will go through what are the management objectives for internal control and audit and why they are important, especially the focus is on best practices in an organization. So we will go through the differences between internal control and internal check first, and then followed by an in-depth discussion of internal control, audit, and conclude by internal financial procedures. So here is the chapter outline. Here is the chapter outline. So internal control and internal check. First of all, we need to introduce what is internal control and what is internal check, and why and what are the differences between these two key terms. Internal control is the process designed, implemented, and maintained by those charged with governance, management, and other personnel to provide reasonable assurance about the achievement of an entity's objectives. And here some of the key words here, like the process. Internal control is a process. It's about governance, management, and other personnel to provide reasonable assurance. Reasonable assurance. So here we have some key words or key concepts behind internal control. First, it is a process. And what is internal control for? It's for providing reasonable assurance. So we understand what is internal control. Basically, it is a process designed, implemented, and maintained by the management or by whatever to provide reasonable assurance. And about what? About the following areas. To achieve the entity's objectives for, first, reliability of financial reporting. That means internal control can help to ensure the financial figures are reliable. Next, effectiveness and efficiency of operations. Internal control, say for example, the process of internal control, help to achieve the operations efficiency as well as the effectiveness. And third, it's very important as well, internal control helps for the organization or entities to comply with applicable laws and regulations. Here is an example. An accounts department may have a policy to check the additions and multiplications on a purchase invoice received before it is approved for payment. This control would help to ensure that the correct amounts are paid to the organization's suppliers, and it would help or improve the reliability of the amounts reported as purchases. So here is one example what is internal control. And next, internal check. Internal check is different from internal control. It is an element of internal control. In other words, it is a part of internal control, and it concerned with ensuring that no single task is executed from start to finish by only one person. It is very important because each individual's work is subject to an independent check by another person in the course of that person's or other person's duties. The purpose of internal checking here is to reduce the likelihood of errors and fraud. Errors should be reduced since an employee will take more care over their work if they know their work will be checked by another person. and any errors which are made should be spotted by the second person so that corrections can be made. At the same time, an employee will be dissuaded from defrauding the company if they know that their work will be checked and that it is likely that their fraud will be discovered. So here, as said, each individual's work is subject to an independent check by another person in the course of that other person's duties. So in other words, internal check means no one in the company can execute a single task from start to finish. And for the task, even the one person can execute it, but the other have the responsibility to check, to ensure there's no errors and frauds. So here is the key. The purpose of internal checking is to reduce the likelihood of errors and fraud. To summarize between the differences between internal control and internal check, internal control here is the big box. It contains a lot of control activities that we will cover later, and internal check is only part of it. Here is an example that I would like to share with you about the meaning of internal control and internal check. An example is about a bottling company or a bottled drinks company. It sells bottled drinks to supermarkets and other retailers. The company maintains its inventories in a central warehouse. So there's a central warehouse, and internal controls would be established by management to ensure the security of the inventories and to ensure the accuracy of accounting figures of inventories included in the financial statements. So internal controls will be set up by management team to ensure the effectiveness and efficiency, as well as whether they can secure the inventories. And controls procedures or controls should be classified as two types of controls. First, physical check or physical controls. Physical controls means like here, if you read through this picture, in the warehouse, we have the gates or the front door locked when not in use, and banning visitors from entering the warehouse storage area. At the same time, there's a regular inventory counts. The inventories held could be counted every 6 months to check the accuracy of the continuous inventory records to ensure the consistency of inventory records in the physical location as well as the financial records. So we have the typical controls here, the physical control and regular inventory counts. That is like the gates, the locked doors, as well as the regular inventory counts. But what are the internal check, or what is internal check here? Internal check on inventory quantities could be implemented at each inventory count by ensuring that no individual counts the items that they are responsible for maintaining. In this way, it would not be possible for an employee to steal items of inventory. That means we have the control, like the physical controls, by putting the bottled water into the warehouse with the door locked, as well as we have the regular inventory counts. But for internal check, we have to ensure for the person responsible for inventory counts are not the same person for those in the warehouse to put or to store the goods. In other words, some of the company would like to invite the accounting department staff for regular inventory counts, or they monitor the staff in the warehouse to count the inventories to make sure there's a proper monitoring or internal check in these procedures or in this process. So it can ensure the count is effective and no stolen items will be happen in the warehouse. So let's now move on to the purpose of internal control. As we discussed before, internal controls is the process, and what is the internal control for is for providing reasonable assurance. Therefore, internal controls is to prevent risk occurring or to minimize the impact of risk in the operations. And they help management to achieve the entity's objectives. And we summarize here in 5 objectives. First, the orderly and efficient conduct of the business. Second, safeguarding of assets like inventory, like cash or fixed assets. The prevention and detection of fraud and error. Just example in the bottled water example. And the accuracy and completeness of the accounting records, and the timely preparation of reliable financial information. So here are the areas the management would like to achieve. And remember, for internal control, it's about the risk prevention process. It's about a process. In other words, it is highly related or linked to what we discussed in the financial controls or financial systems and technology. Under the financial systems, we have the purchasing cycle, we have the sales cycle, we have the cash management cycle, we have the working capital management cycle as well. We have different cycles that we mentioned. And now you probably have a basic concept of internal control. But you may ask a question, what is the level and extent of internal control required? And here, I would like to brief you. The level and extent of internal controls required depend on, say here, on what the risks are if such controls fail. So we need to think about whether it is associated with legal requirements. If it is particularly important that the controls or the stringent controls exist where they are associated with legal requirements, then it's very important that we should have the controls and there's no compromise. And here are the examples of internal controls. First, documents control. Documents are badged and pre-numbered so staff can check that there are none missing. One example is sales invoices. If you don't have a proper control on issuing the sales invoices, it's the problem that the sales invoices are missed or haven't printed and issued to your customers, so you cannot collect back the money, and it hurts your cash flow because you cannot have the cash collection by selling the goods. At the same time, your income may be underestimated or understated. On the other hand, if you don't have a proper good receipt procedures or controls, the purchaser's invoice are missed, for example, then your profits will be overstated because you don't record in your financial statements for the purchasers, because you missed the good received those items, as well as no proper control procedures for purchase, and you don't pay to your supplier on time as well, and you are understate your liability. And finally, your cash flow will have the issue as well. So first, the proper internal controls on documents is needed. And next, authorization controls. Authorization controls are particularly important to require payments to be authorized only with appropriate persons. Imagine, if you pay to your vendor or your suppliers without any senior person's approval. Say a junior account clerk can do the authorization for unlimited amount. Imagine what happened. It's probable for the junior staff, because only the junior staff, account staff, can authorize the payments without any other supervisor need to have the approval as well. So only one person to approve. Then it's a one person approval problem. The other problem is whether the junior staff is an appropriate person to approve all amounts items. If yes, then this staff may authorize false purchase invoices raised by a friend outside the company. For example, then the company pays the invoices and the friend and the clerk share the proceeds. This is a very common type of fraud. So controls, here the authorization controls can help to prevent these required payments by only limited to the senior persons to approve it and not only one person to approve it. Maybe the case is how much of the invoices can be approved. Say if it is less than $10,000 invoices, it can be approved by two persons. One is the account staff, the other is the finance manager. And if it is more than 10,000, say 50,000 or less, then 50,000 or less can be approved by the finance manager, maybe with the finance director. For example, if more than 50,000, it needs to have another approval, say by the managing director or the chief executive officer. So here you can see the authorization controls help to prevent the fraud as well. And we discussed there are two internal controls or examples. One is documents, the other is authorization. And next, we will talk about the components of internal controls. There are 5 components of internal control. First, control environment. The overall attitude of management regarding internal controls and their importance is so-called control environment. The control environment sets the tone of the organization in terms of the control procedures of its or the sense of control of its employees. It is the foundation for effective internal control, providing discipline and structure. It is very important for the senior management to have a very clear and strict attitude on internal control, because if senior management openly engage in unethical behavior and urge fellow employees to ignore internal rules, then the whole tone of the organization will be damaged and the internal control will be weak. Because for the senior management, they don't respect for the internal rules. And for how about for the others? Okay, for the account clerk or for the merchandising clerk or for the salesperson, whether they would like to follow the internal rules, if the senior management is openly engaged in unethical behavior? No. The answer is no. So the control environment is the tone set by the senior management in the organization on how should the organization work with the process, as well as the sense of control of the employees, how the sense of controls can be built for the employees in the organization. And next, the entity's risk assessment process. An entity risk or entity's process for identifying and responding to business risk. So here is whether we have the proper process to do it. And for the business risk, it can be divided into internal and external. So internal versus external. For internal risk or internal business risk, it relates to the business activities such as product development, such as sales, such as procurement, production, logistics, after-sales service, for example. It is internal. And for external business risk, the elements we covered in the pastel analysis, including like the political factors, including the social factors, economic factors, legal factors, technological factors, and environmental factors. So all the external factors, like what we discussed in the pastel analysis, are the business risk to the entity. So an entity should have a process to identify and spotting the business risk and how to respond to them. And once the risk identified, the management must investigate their significance, the likelihood of their occurrence, and how they should be managed. The third component of internal control is the information system and communication. Its relevance to financial reporting objectives consists of procedures and records established to process the transactions that the entity carries out, and to maintain accountability for related assets, liabilities, and equity balances. And the information system must be able to do something. It's very important. First, to identify and record all valid transactions. It's about whether the transactions can be recorded and valid. And also, the transactions can be described in sufficient detail. So for financial reporting, they don't just report the numbers. They should tell the reader what are the information is, or what is the information, and it's better for them to put the description as well. So finally, for the user of the financial statements can classify of those items in a proper way. And the information system must be able to measure the transactions to permit the recording of their proper monetary value in the financial statements. In other words, the information system should not only capture the volume for the inventory, but it also captured the valuation of inventory as well. And the information system should be able to determine the correct accounting period in which transactions should be recognized. In other words, for the sales transactions happened but before end of December, it should be recorded as a December sales. But this accounting system is also capable to do any sales adjustments, because say there's a sales return in early of January related to the sales in December. The accounting system can help to recognize these changes of status of the sales, because for these sales it should not be recognized as sales in December, given it's a short-term sales returns. And also the information system and communication must be able, here the system must be able to present properly the transactions and related disclosures in the financial statements. And the fourth component of internal control is the control activities. Control activities are the policies and procedures that help ensure that management directives are carried out. We'll go back to talk more about control activities, because it's a long list of control activities that we will cover. And the last component of internal control is the entity's process to monitor the system of internal control. So there should be a process to assess the quality of internal control performance over time. We have the internal control, we have the internal control process, but whether the internal control process is effective, it may be effective in this year, but how can we ensure the internal control process is effective in next year or in next decade? We don't know. So there should be a process to assess the quality of internal control performance over time to ensure our system or our internal control systems is up to date to the changes of business environment, because it's a dynamic world. We have to ensure our internal control systems is updated. So let's take a look on control activities and choice of controls. It's a long topic. So first, let's explain what are the control activities. Control activities are policies and procedures that help ensure that management directives are carried out. For example, the necessary actions are taken to address risks that threaten the achievement of the entity's objectives. So control activities are procedures or policies and procedures. And in the financial system and technology, the chapter that we've gone through, in the financial system, we have the policies and procedures. And now the control activities will look deep at those policies and procedures because they help to ensure the management directives are carried out. They need to address the risk threaten the organization development. And for control activities, whether within IT, that is information technology, or manual systems, have various objectives and are applied at various organizational and functional levels. So let's look at what are the activities or control activities that are important. So example of control activities include, first, authorization. Authorization means it's a confirmation of the validity of transactions. Without authorization, the transactions cannot be completed. So a manager signing off an employee's timesheet, and it is a confirmation of the hours stated by the employees on the timesheet. And it helps to ensure the employee is not claiming for hours not worked. So there's authorization for the manager to do it. And for purchasing department, a manager under the purchasing department sign a purchase order, and it is a confirmation that the order is reviewed and can be placed with the supplier. It helps to ensure that the goods are for a valid business use and the items are needed. So authorization here is a confirmation in order to execute a transaction. Without authorization, transaction cannot be completed. And next, reconciliation. Reconciliation is to address the completeness or accuracy of transactions. An example like the bank reconciliation. The balance in the bank statements is not necessarily the same or consistent with the ledger balance. So a bank reconciliation is helping us to ensure cash transactions have been recorded completely and accurately. Sometimes there's a payment record in the bank statement, but not in the general ledger or in the accounting book. So we have to do the reconciliations to ensure the accounting book keep the records for those expenses already paid by our bank. Another reconciliation example is supplier statements. The reconciliation of supplier statements with the payables ledger is helping to ensure a completeness and accuracy of payables. If we don't perform the supplier statements reconciliations, we may miss some of the liabilities in our financial records. And third, verifications. Verifications to address the completeness, accuracy, and validity of transactions. An example is for the batch totals used when inputting data to ensure items are not omitted. What is batch totals? For example, if a clerk input the transactions or input an invoices, for example, input the invoices issued from 001 to 010, say 10 invoices input into the system, and the accounting clerk can sum up all the numbers for these 10 invoices because there's a batch from 001 to 010. There's a 10 invoices in one batch. He can sum up the totals of those batch of invoices and check after inputting all data into the system. If the amount is not the same or omitted, then the accounting clerk can go back to the system again to make corrections. Another case is managers should compare actual spend against budgeted spending to detect unusual fluctuations. It is another type of verification, the budgetary control. If actual spend is significantly higher than the budget, the department may have spent more than it should, or it should indicate an error when processing the transactions. So we set the budget and we compare the actual with the budget. We describe this process is the variance control or variance analysis. After performing the variance analysis, we identify what are the big gaps between the budget and actuals, and we need to do the verifications and address any accuracy issue in the transactions. And another examples of control activities is physical or logical controls. It helps to prevent thefts of assets or data. One example is like the restrictions on access to assets, such as keeping our goods in a warehouse with proper door with locked, or keep our cash in a safe to prevent thefts. Another example of control activities is segregation of duties. It helps to reduce opportunity for any person to commit and conceal fraud in the normal course of their duties. Example like a warehouse staff should not be responsible for the inventory count, as this would not detect if goods were being stolen by staff throughout the year. So as I shared with you an example in the bottled drinks or the bottled water case, the regular inventory counts could be performed by the accounting staff or with accounting staff supervision on those counting procedures. So after sharing with you the examples on control activities, and now we need to think about what is in practice or in the reality. In practice, the choice of controls may reflect a comparison of the cost of operating individual controls against the benefits expected to be derived from them. So here is quite straightforward. If I spend $30 in the internal control procedures or for internal control of control activities, what are the benefits? If it is, say, $30 cost with $100 benefits, then for me, it's the right choice or the right movements to have the controls procedures, because we have the more benefits can cover the costs incurred on the control. One example is like the warehouse. For keeping the bottled water, if I only do the inventory count, say on a monthly basis or on a quarterly basis, I don't need to hire any additional staff to perform the counting. So it's worthwhile for me to do it. But if I do the inventory count on an hourly basis, for example, so in extreme case, in the hourly basis inventory count, first of all, it interrupts the operation. Second, I need to hire additional person for the counting or an expert in counting. Is it worthwhile to do it? The answer may be no, because the bottled water is not so expensive that justify for the company or for the organization to hire an additional staff to do it. But on the other hand, if you are selling gold, like the jewelry shop selling gold and other luxury items, and the counting on those items are required maybe on daily basis, because you have to ensure on every day there's no missing item for your jewelry shop, like for your gold jewelry, whatever, or your diamond. So you have to ensure, because those are very high value items, and the extra cost to hire for the control is much lower than the loss of any jubilee items. So that means the benefit is much higher. In this case, the company, the jewelry shop, should consider to hire extra or additional staff for controlling or for providing the controls of their gold items or jewelry items in the shop or in the warehouse. And many of the internal controls which would be relevant to larger enterprises are not practical, appropriate, or necessary in small enterprises. Managements of small enterprises have less need to depend on the formal internal controls for the reliability of the records and other information because of their personal contact with or involvement in the operation of the enterprise itself. So here are the differences between the larger enterprises and the small enterprises on internal control. For larger enterprises, they have adequate resources to safeguard their assets, so their control procedures or control activities are much more complicated than the small enterprises. First, many employees in the larger enterprises, they are just staff of the company. They are not the owner, they are not the senior management, for example. But for small enterprises, the owners they have to do a lot of operational job or operation work. In that sense, almost all authorization, for example, because we just mentioned there are two types of control. One is the document type, the other is authorization type. And for small enterprises, the authorization type, the control is done by the owner, for example. In this case, all payments have to be approved by the owners. Then, for small enterprises, it's not practical to have a lot of segregation of duties or authorization matrix for the small enterprises to do, because no matter what, the owners will sign on the payments approval. So it can make it more simple, but for larger enterprises, no, because even for $1 million expenses, it is approved by, say, a local team manager or local team head without the need to have the global headquarters approval as well. So for larger enterprises, they have a more detailed, sometimes it's not practical way for small enterprises to do the internal controls. So here, that's why the differences between larger enterprises and small enterprises in the control activities. Here, I would like to share with you some examples of specific control activities. First example is approval and control of documents and transactions of importance. In other words, we have to set different type of approval or set an authorization matrix for different types of amounts to be approved. An example is, in a purchase system, there should be preset authority limits. Say, for example, order up to $1,000 could be approved by a department head, and if up to $5,000, then any director in the company can approve it, and beyond these levels of expenditure or invoices should be approved by the board chairman. And next, controls over computerized application and the IT environment. So here, because right now many organizations, they have the IT systems and many transactions are processed electronically, so they are not putting in the manual boxes or through the book and other paperwork. So the controls right now on the computerized applications can help to improve the control process or activities. And checking the arithmetical accuracy of the records. It's much more important for this arithmetical accuracy by checking. Like The controls include checking the cast on the purchase invoice. If we got the invoice in the paper form, then we need to ensure the total amounts of the purchases is consistent with what we ordered in our purchase order. So we need to check two sets of data. First, the amounts in our purchase order, and the second, we need to reconcile this amount with the purchaser's invoice received. And maintaining and reviewing controls accounts and trial balances. And for control accounts include sales and purchase ledger control accounts. So we can review those control accounts and trial balances to ensure there's no significant differences or any big issue on those purchases and sales. Another example is comparing the results of cash, security, and inventory accounts with the accounting records. In general, for assets like cash, inventory, we have to perform the stock or the physical count on a regular basis. If we have the cash, say we need to count the cash on a weekly basis sometimes, if we hold a lot of cash. And for inventory, it depends on whether they are significant or not in terms of value. If the value is not very significant, we need to perform the physical count on a quarterly basis, maybe. And if the value is very high, like jewelries, then maybe we need to count those items on even on a daily basis, and check and reconcile to our accounting records. And comparing internal data with external sources of information, such as supplier statements reconciliations or bank statement reconciliations, it helps to ensure our internal data records are up to date and complete. Producing and reviewing exception reports. Here, the exception reports means any transactions exceed the normal range, then we need to generate the exception report. For example, like purchasing transactions above certain limits or payments made without a purchase order, then a report should be generated in the accounting systems, so the senior level of management can review of those items and to see whether there's any exception or issues in the transactions. And the last example here is limiting direct physical access to assets and records. It is an important general principle with respect to assets and records, is that segregation of duties. In particular, there should be a division of responsibilities for three different things. First, authorization or initialing transactions. Especially for authorization, we need to ensure who prepared the documents should be authorized or approved by another person. It should not be performed by the same person. And for segregation of duties or limiting direct physical access to records, we need to have physical custody and control of assets involved. Here's this example, what we shared before about the drinking, the bottled drinks example in the warehouse, and who keep the warehouse should not be the one who count the items in the warehouse. So the physical custody, it also required a segregation of duties as well. And for recording transaction, for those who input the data in the accounting system, he or she cannot approve it or approve the transactions because there should be one person to review the numbers and descriptions that the input is correct. And it's better for a larger enterprise for reviewer should be separate from the approver. So there are three persons in completing the transactions. First First is the the person who record the data into the system. Next, the reviewer of the transactions. And the third one is another person to approve it. So now move on to discuss about the three types of control. Three types of control here. In this class, we talk a lot of control activities. We talk a lot of examples. So right now, it's time for me to summarize three major types of control that management should consider. And first is preventive controls. These are controls that prevent errors and frauds occurring. For example, authorization controls should prevent fraudulent or invalid transactions taking place. And other preventive controls include segregation of duties, recruiting and training the right staff, and having an effective control culture. So in other words, we share with you one example, like we have the document control, we have the authorization control, and for document control is also an preventive controls procedures or activities, because we have pre-numbered sales invoice or sales invoices. So under this preventive control procedure, we issue the sales invoices to our customer, and any missing items will go into the second control or types of control is detective controls. And these are controls that detect if any problems have occurred. So this is detection. They are designed to pick up errors that have not been prevented. This could be exception reports that reveal the controls have been bypassed. As I shared to you the example, like the pre-numbered sales invoices, if there's we can generate a report showing any sales invoices issued, and spot out what sales invoices are not issued or avoided. Like if there's a number 13 sales invoice avoided, not issued to the customer, we can print out a report showing all unissued invoice in the exception reports. So we know whether they are properly approved for any issue in the sales invoices. Say some cases it's just like the errors, typing errors, then the invoice will be voided. And for some cases, the management can spot out any issue in a particular control activities, like in the exception report I just mentioned, like the sales invoice exception report. And the last type of control is corrective controls. These are controls that address any problems that have occurred. So when problems are identified, the controls ensure that they are properly rectified. And examples of corrective controls include follow-up procedures and management action. So here are the procedures document for how to correct the transactions or rectified. So it's not the best for an organization to do the corrective action, but it's better than none. So there are three different types of control here where we describe the preventive controls, the detective controls, and corrective controls. And the most important thing here is an organization is ideally to focus on preventive controls, because it helps to minimize any other errors and frauds in the observation, like in the detective control procedures and the corrective control procedures. So in-class question here is an statement. A company's internal controls can be so well designed, and they eliminate the risk of failing to achieve the company's objectives, whether this statement is true or this statement is false. And remember here, internal control is a process designed, implemented, and maintained by those charged with governance, management, and other personnel to provide reasonable assurance about the achievements of an entity's objectives. So it's a reasonable assurance, and you need to think whether internal controls can eliminate the risk of failing. So it is not perfect, honestly, for internal control. So they provide reasonable assurance, and whether you think this statement is true or false by recap or by showing here by our discussion on internal control, the definition, because we describe it is a process design and also it provides reasonable assurance.